So I'd like to bring to the stage Dr. Mark Dotzour.
Thank you. Let's see if this mic will work here. On 1, 2, 3. How we doing? Y'all in the back corner, we good? Great. It's great to be here with you today. It's fun to think about real estate academics. I was just having a flashback to my first college level real estate class in 1974. And I'm thinking that's like 45 years ago. I've been hanging around real estate academics. It's fun working with real estate programs. A month from now, I'll be doing this very same thing with the University of North Carolina at Chapel Hill for their meeting, kind of like this. So it's real pleasure for me today. This feels a little loud because when I start talking about Congress, it's going to get quite a bit louder in just a second. I don't do Zig Ziglar, power positive thinking, let's put some lipstick on a pig and go sell something kind of speech. And I don't have any self-esteem, so frankly, I don't care if you do either by the time we're done here. But I do this about 70 times a year for the last 22 years, over 1,600 of these, so I just love doing it. My goal is to hopefully give you some information that will help you provide advice to clients and your families to make the best business decisions you can make. And I'm always privileged. My audiences are always at the top of the food chain, whatever part of that food chain there is. I don't pretend to be as smart as you in your market or what you do. I just try to do homework for information that you might find useful, and you just don't have the same amount of time because you're serving clients and making deals. So with that said, let me see if I can get this guy to function. I assume it's on. Yes. And it doesn't seem to do anything. How about if we go to the first slide? Maybe we could do that until we get this little guy fired up. It's always a hazard to being the first one up. Can we just touch the laptop back there and just... I'll go ahead and start. I do this 70 times a year, so I kind of remember it. Thank you. I like to have a picture at the front of all of my presentations to try to present the whole economy in one picture. Last year, it was a ship sailing out of the Savannah Harbor. The title of my presentation all last year was Clear Sailing Ahead. I couldn't find anything that looked like it was really something to be concerned about as a business person. And that was fun all year until along about July. And then for the first time in, like I said, 1,600 presentations, I uttered a 4-letter word in the middle of my presentation, and then I did it 2 more times before it was over. That 4-letter word was boom. I've been making these presentations since '97, so I've seen quite a few ups and I've seen quite a few downs, lots of rodeos, but never have I said we're in an economic boom. And last summer, it felt like we were in an economic boom. I was using the metaphor of a rocket. It wasn't any longer a freighter going out of Savannah Harbor. It was a rocket going straight up. And last summer was an amazing period of time. And then somewhere along about September, October, things started slowing down a little bit. I do this all week, every week, virtually, all over the country, Republican, Democrat places. It doesn't matter to me. I'm apolitical at all. But I noticed this kind of hand-wringing anxiety out of people, and it seemed to be people that were a little older. And I couldn't quite understand it because all the data I was showing was like straight up rocket, but I could literally feel the anxiety out there in the audience. And so as I thought about it, I started looking around. It's like, where's this anxiety coming from? And I'm going to hit that point blank today. When I'm talking to people in the real estate business, if I'm talking to people in commercial real estate, which that's the approach I'm taking today, is there's usually about 3 things that people in commercial real estate want to talk about, and that is, are my buildings going to continue to fill up? What's likely to happen to the value of my buildings? And what's likely to happen to the cost of borrowing for buildings or the cap rates that go along with the cost of borrowing? Everything I'm going to talk about today is related to those 3 topics. So my overarching theme for 2019 is beginning our initial approach for this flight. And when you're at an initial approach, the pilot's saying to you, okay, we're still at 36,000 feet, we're still going 500 miles an hour, but we're beginning our initial approach. What that means is we're not going to gain any more altitude. That means we're not going to gain any more speed. That's what it means. But what else does it mean? Next slide. Let's try this for a minute, and then I'll push this button again. I don't want to overdo it. Well, actually, okay. Here's what it means. We're not touching down. Touching down, in my mind, would be having a recession. That would mean that we stop hiring people. That's not on the horizon right now. I can't believe how often I see in the financial media about a recession could happen between now and the end of the year. That's just, I don't see the data anywhere that supports that kind of theme. Keep in mind, I'm an economist. That means there's a 50% chance anything I say is wrong. But you could have paid $500,000 to get Janet Yellen or Alan Greenspan, and their odds of being correct aren't any better than mine. Not touching down, no recession this year, and not a crash either. A crash, and so I think 2019 is going to continue to be a good year, and I actually think 2020 is going to continue to be a decent year as well. And so I get it. I don't expect you to believe a word I say. You've never met me before. I went to school at the University of Texas at Austin. Then I worked 18 years at their arch enemy, hated rival, Texas A&M University. And I hardly tell anybody this, but I also went to the University of Oklahoma before that, so that ensures nobody likes me anywhere. And I have a beard, so I don't expect you to believe a word I say. The facts will be up here, and I've given the university permission to distribute the PowerPoint. And if you want to put your name on it and give it at a local Rotary Club or something, you've got my permission to do that. I'm going to try this again. Come on. Yes. Here are the facts, and I could give you 15 facts about why this economy is still virtually a rocket. And I'll just give you 4 or 5. Don't need to belabor the point. Last month numbers came in low, but in January, 304,000 people getting a job. This chart is full of absorption of commercial. Might as well just put on this slide, absorption of all commercial real estate space. 304,000 people. Every month, somewhere between 89,000 and 300,000 people get a job. Last month was a low number, 20,000. With the government shutdown and so forth, I've kind of given up on the government numbers for a couple of months. I'm just going to give them a pass. It's like, look, you didn't pay them, you made them go home, and then you expect them to do something. That's just not relevant. So I don't know if that 20,000 number was relevant or not. As an economist, never get excited about one number. But here's the fact. Every month that's going by for years now, 80 to 300,000 people are getting a job. And in addition to that, wages are going up, getting close to 3.5%, maybe even a little bit north of 3.5%. This is great. And some of you in the room are worried about runaway inflation. I totally get it. How many of you in the room, come on, you can admit it, how many of you in this room still use an HP 12C? Yeah, quite a few. I get it, and it's good. Yeah. And if you don't know how to use one of those, you got to go for higher education because they work backwards from those other ones that you used to use. I totally get it. But what I've learned is there's almost 100% correlation between people that use an HP 12C and people that are worried about runaway inflation. Okay? It's like if you hit the wrong button 3 times in a row, it goes, inflation will run away in 6 months. Buy gold immediately. Okay? I was out on the road in 2009 and 10 at that point, just like I have been for the last 20-some years, and everybody's starting to talk about buying gold. And I remember we had an alumni meeting there, and I like to crack stupid sayings because I found out as a teacher, the more absurd example you can use, the stupider thing you can come up with a story, is people will tend to remember it for a long time after that. So all these people out there were worried about runaway inflation because the Fed was printing $4 trillion. Remember that? And they were talking to me about buying gold, and I said, you know, if you're even thinking about buying gold, I would just recommend you take cocaine because at least you'll feel good before it kills you. And that worked fine except for one person in the room who happened to be the dean of the business school at A&M, and his jaw dropped. Like, oh my gosh, Mark, what did you just say? Well, I used to have to say, and that's not an official position of Texas A&M University, but since I don't work there anymore, I don't really care what their
official positions are anymore. But why I was saying that at that time was I was trying to help people get over the idea of runaway inflation. I'm going to hit directly on that in a minute because I bet you there's people in this room, like every other room I'm in, that's expecting higher inflation. They're expecting higher rates. They're expecting higher cap rates. They're hearing clients saying, well, we're going in at this kind of cap rate. If we hold for 5 to 7 years, we'll be going out at a different kind of cap rate. And I want to address that head on because I don't believe that's going to happen. I've been trying to coach people since 2008. Runaway inflation is not in the cards for this country, with one exception, and I'll get to that before the end of the program here. But for those of you that are worried about runaway inflation, you might just say, Mark, this slide shows that wages are going up. Wages are now going up at 3.5%. It's just a matter of time before we have runaway inflation. Well, this chart here goes back to 1980, back when I was at the university studying real estate at the time. Wages during that period were going up 9% a year. There is absolutely nothing inflationary about wages going up 3.5% a year. It's great. After 2009, the financial apocalypse that happened in 2007 and 8, after that happened, wages didn't go up at all. Cops, firefighters, teachers, no pay raises for years. This is good for America, gang. This is not something to fret about. So between these two slides, 80 to 300,000 people getting a job every month, and the whole country getting a 3.5% pay raise just is not the kind of ingredients for a recession coming on. There's 7.3 million jobs open in this country. This comes from the Bureau of Labor Statistics. This number 2 years ago was 4 million jobs. Now it's 7 million jobs. Back when the government shut down in January, people were asking about that, and I said, I feel really sorry for people that work for the government because they're laid off, they're not getting a paycheck. I feel sorry for them because they chose the wrong employer to work for. At that point, there was 7 million jobs open all across the country. So as we sit here today, this is where we live, gang. Jobs being created, wages going up, and another 7 million jobs open, and we got people wringing their hands because they watch CNBC, which is about the only TV I watch anymore besides professional sports, and sitting around worrying about a recession happening. I just don't see it. Consumer confidence is virtually off the chart. I never thought I would see the day that consumer confidence would get north of 2007 again. I mean, think back to 2007. You can buy a house with a 107% loan-to-value ratio with no job and bad credit. I mean, how can you get more euphoric than that? For those of you young enough don't understand how that worked, you could buy a $200,000 house, get a $14,000 check, and they don't even check your credit to see if you got a job or not, and you can do that 50 times. So when people tell me it's like, oh, the housing market, we're just getting ready to repeat again what we did last time around. We never seem to learn, do we? Yeah, we learned. How many people do you know is getting 107% loan to value on any house anywhere without getting their credit checked? That ain't happening anymore. Sure, house prices are high. That's because we're not building enough of them. That's called economics. In fact, as I'm looking around the room right now, the housing market is starting to slow down for real. In fact, I'll get that, man. I don't want to get over my skis here. But here's where the media is playing games with you. And I don't care if you're 75 years old and you're the smartest real estate man or woman ever in the history of the business, you probably already figured this out, but a whole bunch of other people haven't. If you're watching TV at all to stay informed as for news, for business decisions, you're in jeopardy of ruining your career. I'm serious. It's nothing but propaganda and gossip. And students at A&M, I volunteer to teach 3 hours once a semester at the business school, Mays Business School. And one of the students asked me afterwards, like, okay, how do you stay informed? Well, it's certainly by not watching any news, period. I don't see any difference between Al Jazeera and Fox News or MSNBC. It's all propaganda to me. You can stay informed totally and never watch TV. In fact, there's enough young people in the room here. I'll share this with you right now. You want to change your life trajectory forever? and not only change the life trajectory for you, but your kids in the future and maybe your grandkids. If you shut off TV and never watch it again, and you allocate 4 or 5 hours a week to training like a professional athlete for your career, you won't be the same, your family won't be the same forever. It's the biggest waste of time you can get, and also it's negative because I think this is where a lot of this hand-wringing anxiety comes from, is people watching TV and they hear nothing but bad news and they hear nothing about good news. So you look at this chart. The reason I put this up here is because the headline for the last 3 months is consumer confidence is declining. That was so exciting for Wolf Blitzer to tell everybody, consumer confidence declined a little bit in December. Oh, it declined again in January. Oh, it declined again in February. Look at the numbers here. The headlines are consumer confidence is declining. Maybe that means the recession's going to happen after all. They never show you this, that it's near record high. That's my point. Why will things be slower? It is slowing down. I'm not in rocket mode anymore. But we're still at 30,000 feet, cruising along at 500 or 600 miles an hour, and that's a great business environment to be in. Here's what's slowing down. The housing industry appears to have peaked. I can't figure this out. I'm on the road all the time. You guys have the most awesome panel of speakers. I'm going to stick around today to hear along with you, and in the morning as long as we can before I got to go to the airport, because your panel of speakers are awesome. But I haven't found one person in America yet, including chief economists of real estate, everything in America, that can explain why the housing market has peaked. Traditionally, if you have job growth, cheap mortgage money, and home price appreciation, the housing market is in an upward trajectory. And the only time I see something in the journal, housing market slowing down in Vegas. And then in the middle of that story, there's a quote from a millennial. They always just label them millennials, not just a young man or a young woman. It's a millennial who's saying, well, we saw what happened 10 years ago, and we saw prices drop 20%, and we're not going to repeat that same mistake again. And I think we have to address an issue here, because I think millennials have a problem just like my generation has a problem, and just like my dad's generation had a problem. My dad's gone now, but he witnessed a depression in the 1930s, and it affected his investment decisions, his consumption decisions. It affected everything he did, waiting for the next depression to come, and it never did. Now, my generation has a different problem. We saw high inflation for about 5 years, from about 1975 to 1980, and we are still waiting for the next round of high inflation. All right? That's why we wanted to buy gold at $1,300. Exactly. And so we have been waiting for that. I don't know how many people have told me, it's like, well, when we had the financial apocalypse in 2009, and then in 10 and 11, then all the real estate people started going, when's the next RTC going to happen? When are we going to buy? When are they going to flush all that out of the? And Mark, find out. Talk to these guys at the Fed and find out when they're flushing this stuff out of, because we got $4 billion in real estate RTC flush fund ready to go. And it never happened. And runaway inflation is not going to happen again in my lifetime either. For the millennials, they got a different problem. They saw a financial apocalypse happen 10 years ago, and we mistakenly call it the Great Recession. That was not a recession at all. That was a collapse of the global financial system. How often do you suppose collapses of the global financial system occur? Like every 7 years or so? That's why you don't need to buy a house in Vegas, because, man, you know, FDIC is going to print $4 trillion and start buying mortgages, and commercial paper market will freeze up. Nobody's going to make payroll next week. That's probably not going to happen in your lifetime again. And why am I saying this? I don't get paid to sell houses. I don't care if you ever buy a house. It means nothing to me. I'm trying to help you make good business decisions, and here's what I'd like to say to you, is that if you're 30 years old, 32 years old, and you've gotten married, and maybe you're going to have a baby pretty soon, and you and your spouse have had a dream of owning a home, It would be an absolute travesty for you not to do that right now because you think home prices are high and because you think we're going to have another financial event like we had 10 years ago. That's all I'm saying. Don't be afraid to buy a house. If you are, just go back and look. If you live in Florida, just have somebody for you say, what was the average home price in Florida in 1980, and compare that with 10 years later, 1990. And then do the same thing for 81 and compare what, if you bought in 81 and 92 and sold in 2002, if 2005 and 2015, take that 10 years and look at every year back as far as the MLS data will go in this state, and look at it, whether you bought at the bottom of the market or you bought the absolute top of the market, and find out how many years, if you bought in today's number and held it for 10 years, how many times did you lose money over the last 40 years? And somebody took me up on that in Texas, in North Dallas. She sent it to me a couple weeks ago, and that was never, there was no year ever going back to 1980 where you bought a house and held it and for 10 years. So anyhow, that's all I'm saying. Nobody can explain exactly why the housing industry peaked, but it has. The auto industry has peaked too. It peaked last year. These are major components of our economy. This is the best news I've got all day. Smartphone sales declined for the first time last year. It's like finally, everybody on earth that has to have one of these things finally got one. Oil prices aren't going to go up very much, I don't think. And when I talk in Houston, or if I talk in Oklahoma City, or if I talk out in Midland, Texas, where it still smells like, you go to Midland, Texas, you get off the plane there, it smells like crude oil. It's just coming out of the ground everywhere. Oil prices are unlikely to go anywhere either because Donald Trump, I think, has figured out how to keep oil prices low. I mentioned that guy's name just so you know. I'm going to talk about federal policy as it affects business decisions in a little bit. And when I do, I'm actually going to say something positive about Donald Trump, which I know is illegal in at least 39 states. All right? I totally get it. I'm not a Republican. I'm not a Democrat. I was a registered cynic 7 years ago, and now I view the Democratic Party and the Republican Party as the biggest blight on our economic future. That's my political background, okay? So with that said, I'm going to say one thing or two good about Donald Trump because the guy makes amazing mistakes. The guy's just dumb in a lot of ways. That's just all there is to it. I make mistakes too. He's no miracle guy. He makes mistakes too, lots of them. But the one thing that guy's a genius at is called fiscal policy. And if you don't know what that is, I don't blame you because we haven't had fiscal policy in America for the last 20 years and we finally got it. And all it is a Congress and a president that creates an environment that encourages businessmen and women to hire people. It's a really good thing. Trump got over his skis a little bit and got into geopolitics and put Iran in the doghouse. Iran probably should be in the doghouse. What does he do? He puts up a wall over Iran and says, we're gonna not allow anybody to buy oil from Iran. When you take a big producer offline like that, what happens to the price of oil? The minute he did that, price of oil goes 50 bucks, 60 bucks, 70 bucks, 80 bucks. Then what happened? Visualize behind this thing right here, there's a guy, 60-year-old guy, nerdier than me, speaks the same language, but he's a lot more powerful than me. The guy's name's Jerome Powell. He's chairman of the Federal Reserve of the United States of America. Jay Powell, right behind the screen here. He's sitting there. What do Fed chairs do when the economy's at near rocket mode and there's no inflation? What do you suppose that Jay Powell does every day? He's probably sleeping most of the time. It's like, I don't need to do anything else. We're meeting our twin objectives that you all know about. And when we're meeting our objectives, I don't need to be doing something else. Okay, all of a sudden, Trump puts Iran in the doghouse. The price of oil goes to 80 bucks, and somebody knocks on I'm going to do this on purpose. Somebody's going to knock on the door. Jay, wake up. Oil just went to 80 bucks. What? Oh my gosh, how'd that happen? We didn't see that in any of our models. Well, Trump put them in the doghouse and it's up to 80 bucks, and that could mean higher inflation ahead. So what does Jay Powell do? What is the only tool Jay Powell has to counteract a threat of inflation? We need to raise interest rates, so let's start raising rates. And so that's what he does appropriately. I mean, if you read any history about the Federal Reserve, you totally get it, and you totally know, well, I don't want to give that part away just yet. So anyhow, he wakes up, starts raising rates, and then what happens? Stock market starts to drop. Now, Trump has taken credit for this economic recovery and all these jobs, and he should. He created fiscal policy that has created an amazingly powerful environment for businessmen and women to want to hire people. That's all fiscal policy is about. And so, but the other thing he made a mistake in doing, in my mind, was taking credit for the stock market. That's not a good idea. Nobody knows when the stock market goes up and down. Okay, so puts him in the doghouse. Jay Powell wakes up, starts raising rates, and all of a sudden the stock market starts going down. So what does Trump do? That Jay Powell, I just hired him like 3 months ago. He's the biggest disappointment I've ever had. That was the biggest mistake I ever made, putting him in as the Federal Reserve. And a few days later, Trump staff looking to see if they can fire Jay Powell. Okay, that's what this is going on here. And so all of a sudden, what happens? I put them in the doghouse, and I saw oil go to $80. I wonder if I can let them out of the doghouse. I don't like that anymore. I want to get reelected. So how does he let them out of the doghouse? Read the Wall Street Journal. Don't watch CNN, Fox News, MSNBC, Al Jazeera, none of that propaganda, and get off your Facebook for life. Never get on that thing anymore. You'll be way ahead in your career and life as well. But anyhow, so all of a sudden, he creates an exemption for 6 or 8 of the largest economies on earth. I put them in the doghouse so nobody can buy oil from Iran, but now all of a sudden, oh, Germany, China, Japan, Taiwan, Korea, you can go ahead and buy oil from them. That's where we are today. They're sanctioned, but the 6 or 8 biggest countries on earth are exempt from the sanction, and as soon as that happens, the Iranian oil comes back into the market, and oil goes from 80 to 70 to 60 to 50, and now what is Jay Powell doing back here behind the screen? I'm back in bed. I'm asleep. I'm good. I'm not going to raise rates at all. And guess what's happened to the stock market? We're almost back up to record highs. So Trump saw exactly what happens to him when he caused oil to go up. My theory is that he wants to be reelected again, and he saw what happened there. So with a stroke of a pen, he made oil go to 80, and with another stroke of a pen, he dropped it back down to 50, and the stock market's back at record highs. So my hypothesis is he's going to try to keep oil in this current range right now. And of course, we're playing hardball with China right now with tariffs. We need to play hardball with China. This is another thing the guy's done right. Kind of goofy things he hasn't done right is like tweeting Arnold Schwarzenegger about how poor his ratings were on Celebrity Apprentice. I mean, that's just stupid, you know? But playing hardball with China is good. We need to play hardball with China. They steal our intellectual secrets. They don't honor civil rights of human beings. And so, yeah, we're getting this done. And I hope we do. It needs to be done. I don't know why we buy anything from China anymore. I love Chinese people. We have lots of Chinese students at Texas A&M, and some of them came to our house and taught Luann and I how to play Chinese mahjong. And they were laughing and listening to us trying to speak the Chinese words on the mahjong things. And at the end, Johnny said, you know, Mark and Luann, this was very close to a Chinese mahjong experience. The only thing missing is we need to be smoking unfiltered cigarettes while we're playing the game. So I love the Chinese people, but I do not like authoritarian communist dictatorships that don't recognize civil rights and don't recognize the rule of law. That ain't a trade partner. And so I hope we play hardball with them, because a trade partner means, hey, partner, you get stuff and you get jobs and wealth, and I get stuff and I get jobs and wealth. And that's not how it's working. And so for a while, we got all this uncertainty with trade, and I'm sure that's what part of this hand-wringing is about. And if I'm Trump and I'm a theater major like that guy has to be, I mean, he was on TV, what better theater would be is for the next 15 months to have this China trade war thing coming and going. Comes out for a week. Looks like we're making progress. Oh, man, progress is really lame. It looks like we're making progress. Oh no, progress is being late. Well, if you were his advisor, when would you have a breakthrough on Chinese trade agreements? Would it be 2 weeks before the election, 2 months before the election, somewhere in that period where all of a sudden, boom, we've got the mother of all trade agreements with communist China 2 months before the election? I don't know if that'll happen or not. My major's not in politics. I despise politics so much, I can't hardly stand to watch it. Okay, Congress isn't going to be interested in growth either. I don't watch federal politics at all. I don't watch TV news, period. But I did once we found out we have a new manager in the House of Representatives. I want to know, does that mean anything to you? Does that mean anything to people that got a dog in the hunt with related to real estate, that we got a new manager in the House of Representatives? And when I started listening in, trying to figure it out, I heard two things. We got a new manager in the House of Representatives. How's that going to change business decisions? What are they interested in? Hearings and investigations. And I knew immediately this is a non-issue. This is meaningless that we got a new manager in the House of Representatives. So I'm not going to pay any attention to anything that comes out of Washington, D.C. there, because it's going to be irrelevant. Whatever these people do, these people will veto. And it's just like it was back in the old days when these people had power and these people would veto. Same kind of thing. I'm not a big fan of bipartisanship. I love partisanship because bipartisanship means these people and these people get together, and that's very dangerous for the U.S. economy. So Congress, we're not going to have a lot of growth at the federal level. Corporate earnings appear to have peaked, and defense spending has peaked. So if you live or work in an area where the federal government creates some jobs, supports some jobs, whether it's defense or other kind of jobs, chances are that growth is not going to happen anymore because we're running $1 trillion in deficit. That's the one part about Republicans that I don't like. They're really good at creating $1 trillion deficits and allowing them to happen. We're at $1 trillion right now, and a lot of that extra spending has come for defense spending. So if you live in a town that's got a lot of defense work in it, don't expect much growth in there because I've met anybody in America that's come up to me and go, Mark, you know what, the federal debt is so low, I wish the government had come in and start pushing the deficit up to maybe $2 trillion a year. Now, the people that come up to me and ask that question for the last decade have been saying, you didn't talk about the burgeoning federal debt. It's now up to 13 trillion or whatever it is. I mean, it's way north of that now. And the reason is because it's not a huge concern to me right now. The federal debt is high, but it could go a lot higher and still wouldn't matter, I don't think. But the bottom line is federal budget deficits can't get much higher, so there's not going to be much more positive economic energy coming into the U.S. economy based on government spending out of Washington, D.C. And finally, the threat of runaway inflation right here, you can just give it up. The 10-year Treasury, as we said here today, it's not even 2.7, it's down to 2.6. So all these people from big fancy schools, other than the University of Florida and Texas A&M, where we actually know something about real estate, have been telling you, oh, the Fed's going to raise rates, and boy, mortgage rates are going to go up, and it's going to kill the housing market, and commercial real estate lending rates will go up, and cap rates will go with it, and boy, that means a peak of commercial real estate too. People that tell you that are people that don't have a clue about what really drives cap rates and interest rates for mortgages. And I'll get into that in a little bit. The fact that the 10-year Treasury is at 2.7, what? Jay Powell raised rates 5 times, and the 10-year Treasury has gone down about 0.5% in the last 12 months. Alan Greenspan called that a conundrum. It happened to him in 2005, and when a Fed chairman uses the word conundrum, you better duck, because that means they're mad enough they're going to hit somebody pretty quick. The longest economic expansion since World War II is 120 months, and we're at 117 today. This is where a lot of that nervous hand-wringings come from. 3 months from now, it's going to be the longest economic expansion. That means it's got to be over. And if I'm getting ready to do an office building that takes 2 or 3 years to pop out of the ground, I'm going to pop it out of the ground right in the middle of a recession, so I'm not popping nothing out of the ground. I want to challenge that with some facts. Just because something becomes in 3 months the longest economic expansion doesn't mean it's over. You know when it's over? It's over when you and me and our neighbors wake up one morning and say, I bought everything I want. We got a house, we got a car, we got a refrigerator. Every kid in the house got a new cell phone. I don't want anything, and I'm not going to buy anything next week. And when we reach that point, that's when we have a recession, and it lasts about 11 months, and home prices don't collapse. How long can this last? Come on, little buddy. Here's what I don't hear the discussion about in the news. We had something happen a year ago that happens about 2 times in your lifetime. It's called financial tax reform. It's called tax reform. That happened a year ago. And so the question becomes, when you have significant tax reform, what happens to the economy after you have that happen? Only prior to what just happened last year, 2 times in my lifetime, period. First one was 1964. JFK was president at the time. We had had a recession, and we had the Revenue Act of 1964. What happened? You can see on the left side there, the bar coming down in light gray is a recession, 1960. The tax reform was enacted in 64. Economic activity didn't peak until 2 years later, and the recession didn't happen until nearly 5.5 years after the tax reform happened. Second one, Tax Reform Act of 1986. This is back when I still had my HP 12C. Called the Reagan tax cuts, enacted in 1986. Here's the same chart. On the far left is the gray bar, the recession, 81 and 82. The tax cut was enacted in 86. Peak in economic activity was 88. Next recession was about 1990 to 91. I draw from this a conclusion that 5 years elapsed. So 6 years from the Kennedy tax cuts till a recession, 5 years from the Reagan tax cuts to a recession. I don't see any likelihood that we have a recession this year or next year. These are powerful things. They don't just go away overnight. This to me, and so if you're from a fancy school and you've taken the statistics, you go, well, hey, Mark, are you comfortable with a sample size of 2? And I go, no, but what do you got? Well, we got reversion to the mean. Whenever you hear a financial consultant talk about reversion to the mean, what that means is, I don't know why it went up, I don't know why it went down, but I'm really good at calculating averages. So, early warning system. I don't feel like it's going to last 4 or 5 years. I forgot to mention this. I've been in university arena now since 1987, and I've been with TIAA-CREF all those years, and my whole retirement account, my wife knows this, so she's comfortable with this, our whole retirement account is 70% allocated to TIAA-CREF's real estate account. I'm happy to know that 2 of the Nuveen people are here. They're managing my money, and I encouraged them, gave them a little pep talk. Keep up the good work. So I pay a lot of attention to commercial real estate trends. I've been there since 2004, and I intend to continue to stay there. So trust me, I'm looking for recessions. I'm looking for higher inflation, because if you do get higher inflation, cap rates can go up some, no doubt about it. Early warning system, let's see how that's working for us. As long as profits are going up, businesses keep hiring more people. And profits have peaked. This looks like, to me, like initial approach. Corporate profits aren't rocketing like they were in 2009, 10, 11, and 12, but they're plateauing at a nice high peak. When this starts to drop dramatically, I'll change my story. Trust me, I don't do Zig Ziglar power positive thinking deals. Back in 09 and 10, people would invite me to stuff like this, and they'd say, you know, for an economist, you're still kind of funny, but why is it every time I hear you speak, I want to take a warm bath with a glass of red wine and a razor blade? So I'm not Pollyanna, trust me. Corporate profits. Here's another one. This is a biggie. If you threw me in jail for saying something positive about Donald Trump and I couldn't get out for like 5 years and I only had one slide you'd give me, this would be the slide for me when predicting a recession. It's the spread between corporate bond interest rates and the 10-year Treasury. When people anticipate a recession coming, they think every business is going to go bankrupt, so you don't want to own any corporate bonds. And when that spread is narrow, that means nobody's going to go bankrupt. This economy is bulletproof. the spread on corporate bonds, you can see when you have a financial apocalypse, what was your first name again? Sandy. Yeah, Sandy and I were talking about financial apocalypses. A lot of us lived through this. That spread blows up where nobody wants to own corporate debt. So yeah, I watched that like a hawk. And in 2016, I was a little worried about it. But then all of a sudden, we had a tax cut. And all of a sudden, the bond spreads went back to nothing. Not worried about it at all. And then it widened a little bit here recently, but it's trying to go back down again. As you can see here, this is showing, in my mind, no impending recession on the horizon whatsoever. Small business confidence, the amount of small businesses say they're going to hire in the next 3 months, near a record high. 56% of major corporations say they're going to hire people in the next 6 months. Only 14% going to lay off, and most of those are related to Bitcoin and blockchain. We can get into that later. Oh, and if you're under 35 and you think you're investing in Bitcoin, we need to have a little chit-chat about that, because there's no such thing as investing in Bitcoin. You can gamble in Bitcoin, but you don't invest in it. Just ask 10 people, oh, you invest in Bitcoin. Why does it go up? I don't know. Why does it go down? I don't know. Okay? That's gambling. There's nothing wrong with gambling. I get it. It's not owning real estate is investing. Owning bonds is investing. Owning stock is speculating. Investing in Bitcoin is right there with buying gold at $1,300 or $1,900, waiting for it to go up again. The index of leading indicators for the government. This is pretty good. It's a crystal ball. When it gets below 0, we have a recession. It's nowhere near that. No sign of that happening. So there we are. I know you're not feeling that in the news. The news is designed to make you feel anxious and afraid and angry. That's what you get out of watching TV. You don't get educated. You get afraid, anxious, and angry, and bitter, and hateful. All of that. That's why I don't want it. I can read about it. The Wall Street Journal, I don't own stock, and whoever owns them, anyhow, it's probably Dairy Queen's bought them by now. I don't know who's merged and who isn't. But I'm not selling Wall Street Journal. I'm just telling you there's a good source of news. Let me talk about interest rates for a little bit. Why does it matter to this audience? Because you've been told since 2013, somewhere in there to 16, when we had the taper tantrum and interest rates started going up. I remember people telling everybody, just like in this room, you might want to sell your commercial real estate in 2013 because the Fed is going to stop selling. They're going to start tapering. They're going to taper down how many bonds they own, and interest rates are going to go up. So you better sell. You better sell your real estate. Wouldn't that have been great if you'd have sold all your real estate in 2013 because some financial MBA from back east or so came and told you that? I was just walking in right behind saying, no, not going to happen. And I'm not a genius. I've got logic here. I don't expect you to believe me. Like I said, you make up your own conclusion. But here is the real logic of commercial real estate as it relates to interest rates. Cap rates are moderately correlated with the 10-year Treasury. When I say moderately, cap rates are not correlated whatsoever with movements in the Federal Reserve Fed funds rate. That thing, Jay Powell could raise the Fed funds rate 7 times, and it's highly possible that cap rates would go down. There is no correlation between the Fed funds rate and cap rates. There is some correlation between cap rates and the 10-year Treasury. That's what the only rate I'm interested in is what's happening to the 10-year Treasury. And it's been going down for the last year. The 10-year Treasury bond is not controlled by the Fed. So when they say Fed's raising rates, not the 10-year, because the 10-year bond rate moves up and down with the expected rate of inflation, and that is it. And that's why the 10-year Treasury's gone down 0.5% in the last 12 months, even though the Fed is, quote, raising rates, because inflation expectations are getting lower and lower and lower. So the conclusion is cap rates might go up if inflation expectations go up. What caused inflation expectations to go up in the last 5 or 6 months? Anybody remember that? It was like 15 minutes ago. I totally get it. It's late in the afternoon already. When Trump put Iran in the doghouse and oil went to $80, inflation expectations started to pick up a little bit. But they're going back down. Here's what inflation looks like going back to 1960. The red line is 2.5%. We don't have runaway inflation. If you look up there, you see those big ones. Oil shocks. What happened to those? Why did we have that runaway inflation back in 74 to 79. Oil shocks. That's why people got nervous when oil went up to 80 bucks. Here's who caused it. Do a little history on this. If you're a student and you're going to work in anything that has to do with money, cost of money, you need to know about inflation. If you don't know inflation, you don't know anything about the cost of money, because the cost of money is driven by inflation expectations. Here's who caused it. Muammar Gaddafi over on the left. He was the king or whatever of Libya at the time. American oil companies used to go over there and say, hey Mo, fills up, $1 a gallon. That's what, $1 a barrel. That's what we're used to. Fill her up, Mo. And he goes, not today. New price, $4. Price of oil quadruples in one day. What do you suppose happens to inflation? Everything we buy, my favorite product of all times, Hostess Twinkies, they come on a truck. And the gasoline and the diesel that it costs to bring them. My clothing, 100% polyester. All of this stuff starts going up in value. I used to have a sign that said, don't smoke around me because I'm flammable, okay? But that guy, 74, price of oil goes up to $4. 5 years later, the other guy on the right, that's Ayatollah. I look at that beard, and that's my aspiration. That's what I want to look like with my beard at some point. Not there yet, but Iran changed rulers, threw in an Ayatollah. Here's something that people don't really understand. Ayatollahs have a lot of educational training, but none of it is in petroleum engineering and resource reserve management. They're not specialized to know about producing oil. And when that guy got into office, Iran's production went down the tank, and the price of oil went up. So the price of oil went, under Gaddafi, the price of oil went up to about $10 finally. And then when the Ayatollah came into power in 79, it went to $40. So and stuck. It stayed there. And so for a period of 5 years, oil went from $1 to $4 to $40. And that's that runaway inflation that we, my generation, saw and are waiting patiently for it to happen again. And it won't happen again unless somebody throws a gigantic kink into the energy side of the business and causes oil to quadruple or go up by 8 times, whatever that's called. And that's pretty unlikely right now, especially because in the U.S., it's starting to feel like we could produce enough oil for the whole globe right now, between us and Canada. This is the inflation rate in this century, 2%. And so, as you can see, that's where the norms are. I think the likely, and what do you suppose is going to happen? What do you suppose inflationary pressures will be like if we have a recession? Let's say we have a recession in 2 or 3 years. What do you suppose is going to be the inflationary pressure of that? When the headlines are, recession for real coming up. And businesses stop the hiring pressures. And wage rates slow down below 3.5%. What do you suppose is going to happen to expected rate of inflation when we approach a recession in the next couple of years? The answer to that is it's going to get even lower than it is now. So the 10-year Treasury is at 2.6, as we said here today. That's based on inflationary expectations now. If we get into a recession, it could be substantially lower than that. I personally feel like, and this is, when I said 50-50 chance I know anything about what I'm talking about, this is one of those 50-50 deals. But my intuition tells me that interest rates have peaked for this cycle, that mortgage rates, whatever they got up to at the high, that was as high as we're going to get this time around, because we're not going up anymore. We're doing this, and once you stop going up and then you do this for a while, the next trick is you start going down. And then when we go down towards a recession, the likelihood is inflation will slow down and also interest rates as well. So I want to close with just kind of with a comment about interest rates. Because I said 2 years ago, when the Fed funds rate was at 0, the Fed was trying, if you read their notes, if you read their minutes, it's all in there. There's no secrets in the Fed, and I read those minutes. I don't have any life. My wife is a saint, because that's what I enjoy doing, is reading Federal Reserve bulletins and stuff like that. But anyhow, they were trying to get their interest rate from 0 up to about 3.5%. And why was that? Was there runaway inflation in the last 5 years? No. They were trying to get the rate up from 0 to 3.5 so that when we do have a recession, they can lower them back down to 3 and make it look like we're still in control and we got some bullets left. It's called the neutral rate. What he was trying to, 0 is not neutral. That overheats the economy when you do that for too long. You can get a rate that's too high and cause us to go into a recession. We don't want to do that. They don't want to do that either. The neutral rate is caused to not overheat the economy without causing a recession. Unfortunately, Jay Powell is a rookie, just like all of us are rookies the first month or two we're on the job. This is what rookies do. Somebody asked him about the neutral rate in October. He's already had the rate up to like 2 or 2.25 somewhere in there. We may go past neutral, but we're a long way from neutral at this point, probably. He signaled the market that, dude, we're just getting started at 2.25. We could go up 5 more times between now and a year from now. And the market started to get nervous. And this about the time Trump said, I got to fire that guy. It's the biggest mistake I ever made, and all that kind of stuff, which meant nothing to this guy. This guy is not intimidated by any president. No Fed chair has ever been intimidated by a president. LBJ tried to intimidate William McChesney Martin. Harry Truman tried to intimidate William McChesney Martin. And that's been going on for president after president after president, and they don't fire them for a lot of reasons. If you want to get into that, read a book or two. It's all there. Okay, so anyhow, now here comes Powell back a month later. Market's starting to sink. He hasn't changed rates at all. It's right where it was a month ago. And then he goes, the Fed's benchmark interest rate just below neutral. It's not way below. It's just below. And the market didn't like that either. Market's now down almost 20% by Christmas Eve. And on December 19th, Jay comes back with a third comment. Where we are right now is at the low end of neutral. We're there. We've changed our mind. We're there, meaning we don't have to raise rates anymore. And all of a sudden, here come the Fed presidents from the Minneapolis Fed, the San Francisco Fed, the KC Fed, the Dallas Fed, all of them saying, we think we may not do any more interest rate hikes for the foreseeable future. And all of a sudden, the stock market is where it is today, back to a record high. This is what he won't make that mistake again, and it's not because he's kowtowing to Donald Trump as president. This guy knows he's bulletproof. And so he's stopping raising rates has nothing to do with Donald Trump and everything to do with the economy slowing down. This is what a rookie does. This is my last slide. Here's what the old guys do when you've got the experience. Here's Alan Greenspan. He's not a rookie. He served for about 4 or 5 presidents as chairman of the Fed. And back in 2005, he was trying to do the same thing, raise the neutral rate. And some reporter with Financial Advisor News back in 2005 asked Alan, hey, how high are you going to raise rates? Here's what the old guy does. It's very difficult to know where that so-called neutral rate is, but we probably will know it when we're there because we will observe a certain degree of balance, which we had not perceived before, which would suggest we are somewhere very close to where that is. Usually at this point in a program, I'll say there's only 2 kinds of people that speak like this. Chairman of the Federal Reserve and university presidents. But since we're at a university president meeting, I'm going to revise that back and say the only people that talk like this are Federal Reserve president. Do you know what that means? That means I have no earthly idea, okay? And here's how it works. What happens is when you're going from 0 to something higher, they'd like to get it to 3.5, and they're not there. And so what happens is every time you raise it a quarter, think about an old Christmas ornament that's from your childhood, and it used to be red, and now it's kind of a funky purple, and it feels like it's all dried up. It's still round, but it feels like it weighs nothing, and you're Jay Powell, and you raise it 0.25%, and you're squeezing that little ornament just a little bit. And you raise it another quarter, and you squeeze it just a little tighter, and the ornament is the stock market. And you squeeze it again, and you just keep squeezing that thing until it finally breaks right in your hand. And that's what the neutral rate is all about, is trying to raise that rate as high as they can without breaking something. And he found that out. He broke something when the Dow was down 20% by Christmas Eve. And so chances are, when they do that, they've done that before in the past. 1987, read that one if you'd like. See what happens when you really break something and the Dow drops 22% in one day. One day. We just went down 20% in 3 months. But here's what happens is, okay, you break that ornament, so what do? You just go back behind the corner and go back to sleep. If the economy picks up a little bit, he'll be back out again saying, you know what? We might see if we can get another quarter. And watch what happens to the market. And if the market doesn't care, they'll raise it a quarter. And then they'll go quiet for a while, and then they'll send somebody out from the Minneapolis Fed and says, we're kind of thinking about raising a quarter again. And if the market goes down 9% in one day, they'll go, oh, we were just teasing there. That was something else we had in mind. So anyhow, in conclusion, my opinion is that the economy is still strong, and we're going to continue to create jobs, and interest rates are going to stay low, and it's a wonderful time to be in business. And I just thank you for your kind attention. I hope you have a wonderful time here. You got a lot of wonderful information ahead of you, and thank you very much for inviting me to be here.